Hello again, everyone. It's 8 o'clock in the morning, Chicago time on Tuesday, February 20th, 2024. I'm John Kosar from Asbury Research, and this is your Daily 5. Let's begin with a brief recap from our previous February 1st, your Daily 5, where we pointed out that number one, the S&P 500 was situated just under important support at 4819, and that a decline below there would be necessary to indicate that a corrective decline was underway. 4819 actually held like a rock on January 31st and again on February 1st, and the S&P 500 or SPX subsequently rose by 4% to its current all-time high. We also said that our Asbury Six risk management model was negative on February the 1st, and had been blinking back and forth between positive and negative signals since then. But 4819 support, as we stated, was never broken in the S&P 500 to confirm the intermediate weakness that we saw in the Asbury Six, and eventually the Asbury Six flipped back to positive or green, and the market kept going higher. We'll take a look at that a little closer in just a moment. We also said on Feb 1 that technology was critical to further broad market strength. Since then, the NASDAQ 100 has outperformed by another 1% since February the 9th. But after that, it's given all that relative outperformance back. We think that could be a potential big problem for the market going forward. We also said that our SEAF model, SEAF is an acronym for Sector ETF Asset Flows, showed that communication services, ticker XLC, was still attracting investor assets. XLC has outperformed the S&P 500 by as much as 3% since then. We're going to take an updated look at the SEAF model in just a few minutes and see what is happening now in terms of sector asset flows. Now let's look ahead into the rest of the quarter via my 5 most important charts, data series, and Asbury Research quantitative models that I believe are the most important to be aware of and potentially the most influential to U.S. stock market direction over the next 1 to several months. Let's follow the money. Number one, the S&P 500. Watch underlying support at 48.45 to 48.13. So here we've got a daily chart of the S&P going back to the middle of last year, and I've got some important levels drawn in here. Primary tactical support in the benchmark S&P 500 is currently situated 3.5% below the market at 48.45 to 48.13. You can see it right here. I'm going over it with my mouse. 48.45 to 48.19 is the low from January 31st of this year, and also that big benchmark high from January of 2022. That was the previous all-time high that we broke about halfway through January. Right underneath that is the 50-day moving average at 48.13. That has defined the minor trend upward in the S&P 500 that started back here in the beginning of November. So the takeaway here is that as long as 48.45 to 48.13 is still intact, so is the minor uptrend. So that's, I think, the most important level for us to be watching here in the weeks ahead. Number two, market internals. Blinking Asbury Six warns of a trend reversal. Here's our Asbury Six up top. Those that are familiar with Asbury Research or with, perhaps seeing me here on Stockcharts know that the Asbury Six is our internal model that helps me not to be fooled by these seemingly random jerks up and down that have really become commonplace in the S&P right now. I'm talking about these days where the market might be up 50, 60 points one day, up another 30 the next day, and then suddenly you're down 70 on that third day, and you're wondering if you should hang on to your long, if it's a good idea. You start second guessing yourself, so you take your position off, and then 3 days later, we're making all-time highs again. We back tested 6 out of probably 15 of my favorite tactical tools over my career, and we came up with these 6 that work very well together. We've got the rate of change in the S&P 500, relative performance between stocks and high yield bonds, investor asset flows, volatility, trading volume, and market breadth. When 4 or more of those are positive, that indicates a positive reading for the metric. When 4 or more are negative or red, positive being green, for red would indicate a negative signal. So you can see that when the market is tight, these are all the signals here going back to 2023. You can see that when the market is tight, when the ranges are kind of crunched together, you get a lot of moves. You got a lot of noise. This is called blinking. When the market is blinking back and forth like this, like it was back in March, really through May, through halfway through May of last year, range is contracted. It's blinking. It's telling us that the Asbury Six is indicating to us that the market is getting ready for another extended trend, usually in the opposite direction of where it was. That's basically what happened here. On May the 18th, we had a final green signal here. We actually had a more technical breakout on June the 1st, and the market had an extended move here into August 4th. We had the same thing that happened down at this bottom between the middle of October and the beginning of November. You see this blinking taking place. The November 2nd signal took us all the way up to January 12th. That was a nice long move. Now we're blinking again. Because the blinking is taking place at the top of the range, we're looking at this as a possible indication the market is starting to get tired and it's getting close to some kind of a top. This is a symptom rather than a signal. We would really need to break down through that support level that we just talked about in the S&P 500, 48.45 to 48.13, along with the final red signal here. And we'd also like to see the correction protection model, which is our wealth preservation model. It's a lot less active than this. That model has been positive since November. It's actually been risk on is the term that we use since November the 2nd. So if we get a flip downward here in the Asbury 6 on our CPM model, the correction protection model, it turns to risk off and we break our support that I just talked about it in the S&P 500. That's a tangible signal that would indicate that we're at some kind of an important top. So again, bigger picture, according to the CPM, we are still on a risk-on signal since November the 2nd. The S&P 500 has risen by 17% since then. Number 3, sector rotation. Our SEAF model. Our SEAF model is another in-house model that I built many years ago because sector rotation started to speed up. It wasn't enough to wait till you saw the outperformance on a relative performance chart versus the S&P 500. I needed to be more agile than that. So I started testing different ways to get a little bit more of an edge. And what we have developed is a methodology that measures the velocity of money moving in and out of the 11 sector spiders, which together represent the S&P 500. And we look for a multiple time frame indication that the money is flowing into a given sector. The one that we're going to look at today via we call these rainbow charts. They are a part of the SEAF model, and they look at each of the sectors individually to see how they are doing according to the model on a weekly basis as they move from a favored ranking, which is up here in green, to a neutral ranking, which is here in yellow, to an avoid ranking, which is down here in red. So the reason we're talking about this one today is XLY has moved back into favored status as of February the 8th. You can see it's starting to outperform here. There's not a lot going on yet, but this is a relatively new signal. As long as XLY stays in favored status, according to the SEAF model, this recent relative outperformance is likely to continue. Why do we say that? Because it's not 100%, it's not everything, but a big part of how these sectors perform has to do with money flows. When money flows out of them, they tend to underperform. When money flows into them, they tend to outperform. You could take a look at this here. We have, since May 5th to July 10th of last year, you can see we moved into favored territory in XLY. We got a nice relative outperformance move versus the S&P, which is what this bottom panel is showing of 7%. And then you see we got an extended period of relative outperformance here also from November 7th to December 27th, about 6-7 weeks. We got 2% of relative outperformance there. So again, this is a relatively new signal, consumer discretionary, and we are watching this week to week as if we get an extended move in favor territory, as we did these past two instances, we would be expecting more relative outperformance. Number 4, seasonality. The next 3 weeks are the weakest of the first quarter. And this is what we're looking at. We've got a weekly seasonal pattern in the S&P 500 for the first quarter. So there's 13 columns here. They represent the 13 weeks of the first quarter. The data goes back to 1957. And what we see here is after the week of February 12th, which was last week, which was the 5th strongest week, during this period, we have 3 pretty weak weeks here. We've got the weeks of February the 19th, which is this week, February 26th, and March 4th. The next 3 weeks are the 2nd, 5th, and 3rd weakest weeks for SPX during the 66-year period. I don't look at, personally, or for Asbury Research, we don't look at seasonality as an impetus to put a trade on or to take a trade off, but we do look at it as an environmental tool. It tells us historically when the market might be strong, when the market might be weak, and overlaid with more important things that we're looking at, like our Asbury Six, like technical analysis, where the support is, and a lot of other indicators that we look at. This kind of gives us an idea if this environmental situation is overlapping with what we see is happening right now, and that's the case. The market does look vulnerable up here. Again, we've been overweight or we've been long the S&P 500 since November the 2nd, but we can see a lot of conditions. I'm going to show you another one in just a moment that suggests the market is vulnerable. This is one of those, particularly for the next 3 weeks. Number 5, investor sentiment. There's a lot of ways to look at investor sentiment, and we track a lot of them. The one we're going to look at today is the investors' intelligence data, of which Asbury Research is one of their inputs. Let's have a look. So there's different ways to slice and dice the investors' intelligence data. The one we're looking at today down at the bottom here is the percentage of bears. The II data surveys quote unquote newsletter writers. I don't know that anybody actually writes a newsletter anymore, but they're firms like ours, independent firms, a lot of independent firms like Asbury Research that sells their research to individuals and sells them to money managers. And what this is showing is that through the latest data, they are only about 16 to 14% bearish here. It's a low level of bearishness, means a high level of bullishness. And you can see where we are, and you can see that previous instances when we were down in this neighborhood were all at or right before some pretty important market tops here. Just some that jump out to me. Here's the COVID peak right here. There are many others all the way across the bottom. I'm not going to mention them all, but this is a symptom of market tops. It is not a timing tool. It's not something that we act upon when we see it. But again, I want to know what the environment is like. I want to know where I am in the spectrum. Am I near a bottom of the market, or am I historically near some kind of a top? Right now, this seasonality and other indicators are suggesting to us that we're at some kind of a top. But again, we would need a shift to risk off on our CPM model, the correction protection model, break down through the support that we talked about in slide 1, And uh, those two would have to be in place in order for us to tell us that this symptom is now actually leading into a signal. So there it is. These are my five most important and most influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing. They collectively suggest that the market is overextended and vulnerable to an overdue correction, being led higher by just a handful of mega cap technology slash AI stocks, including NVIDIA, which has risen by a whopping 57% since the beginning of the year. And it actually, this giant move higher has pushed it to be the third largest stock, right behind Microsoft and Apple. NVIDIA's Q4 earnings will be reported after the close this Wednesday, February 21st. So you want to kind of keep a lookout for that. However, as long as the correction protection model retains its November 2nd risk on status, it's too early to assume for us that a tactical top is in place and a correction is beginning. If you like our approach to investing, you can get more research and podcasts just like this one by visiting Asbury Research's YouTube channel and subscribing. You can also request information about Asbury Research's premium services for investors by going to asburyresearch.com and clicking the contact tab. All the way to the upper right is where the contact tab is at asburyresearch.com. Thanks a lot for watching. I hope you have a nice rest of your first quarter. I'll be back here in just about a month with another Your Daily Five via stockcharts.com.